2% target. We're so far away. Is it like waiting for Godot currently? I mean, you're saying it's going to be here next year. Where is it going to come from?
Well, I think what we've seen in the last couple of months is a lot of tightening of labor markets. And I think that's going to eventually put upward pressure on wages. And once that starts to happen, I think we're going to see prices move across the board. We've done a bunch of research, and our analysis suggests that the labor force participation rate in those segments of the market that are usually the last to come back in response to a recession have really started to pick up. And I think we're at the end of any sign of slack in the marketplace.
Well, you get inflation a few months after the things which cause it take place. That's what you're suggesting.
Exactly right.
Now, with that in mind, will the Fed go in December?
So I don't know. So, you know, one of the things that we try to do, that I try to do in advising my colleagues, is really let the data tell me what the marketplace is doing. For us right now, because of the storms that have racked a lot of my district, there's a lot of noise in the data that's going to come out. And one of the things I'm going to try to do is go into the field, talk to my business contacts across our district, and get a sense about how disruptive it's been, and from there draw a conclusion about what I think we should do in terms of monetary policy.
Raphael, I want to go back to the inflation conundrum, or this sort of like sense that global central banks, not just the Fed, but the BOJ, you know, here in Australia with the RBA, really being in the midst of this almost existential crisis, right, of working out where the inflation is and why the Phillips curve isn't maybe so relevant anymore. Is there a sense, we had an earlier guest who said that inflation doesn't matter anymore, and that perhaps inflation targeting is now no longer the most relevant way for central banks to set policy. Would you agree that there's some credibility to that argument?
So I'm not quite there yet. You know, I think that there is much more to learn about what's happening in terms of inflation dynamics. I would say, though, that inflation is starting to pick up in different places across the world. You know, I was in Singapore a couple of days ago, and they were reporting to me that they're starting to see more positive inflation. And I think I'm going to be keeping an eye out to see if that kind of development happens in other parts of the world as well.
President Bostic, I bet it feels good to hear that name attached to you. One of the newcomers to the Fed, and certainly, you know, you bring something that others don't. And I'm not just talking about the fact that you're the first African American in the history of the Fed to head a regional Fed bank. I'm talking about your expertise in housing, because you did have a role at HUD, Housing and Urban Development. You're on the board of Freddie Mac, so you have a sense, I would think, of housing, of the mortgage market. You are seeming to be on board with this forecast of inflation rising, which does open the door to rate hikes. Are you the least bit concerned that the Fed could make a move in a direction that would hurt the very people who are the most in danger of getting priced out of the housing market, even with small moves higher in rates?
Of course, that's something I worry about. You know, one of the things that I've done as an approach in my job is really to make sure that we think collectively about how our policies affect the entire range of the population. You know, we don't just serve business interests. We serve all people in our country, and indeed a lot of the things that we do impact other parts of the world. So I think about that a lot. You know, one of the things that we're really trying to think about in terms of housing that I've been particularly interested in is making sure that when people get into home ownership, they do it in a sustainable way. Our policies contribute to the math that people have to do to figure out whether something is sustainable or not. But, you know, we went through an awful housing crisis in the United States, and in part that was because a lot of people got into homes that they couldn't afford over the longer term. So I'm hopeful that reaction has caused people to be much more strategic and selective about when they get into home ownership, and when they ultimately get there, that it works for them over the longer run.
You know, you were also a professor of public policy at the University of Southern California. I'm wondering about wages. I'm wondering about income inequality. In the work you have done, connecting it to your work now as a monetary policy maker, what do you see as changing? Wages aren't rising. Income inequality is growing.
So I think think the story still is yet to be told on whether wages will eventually rise. But I am very concerned about income inequality. One of the first programs we had at the Atlanta Bank since I've been there was about exactly this question. And what do we do about it? One of the things that we need to make sure is that every person in the labor force has the skills that allow them to get jobs, the jobs of tomorrow. We know that the economy and the economic markets are evolving rapidly. Technology is playing a much more significant role. And we need to make sure that all of our citizens are prepared and equipped to take the jobs that are going to be made available in the next several years. So we're talking about this a lot. We're going to work with job trainers. We just started a new initiative on workforce development that I'm hopeful will generate new innovative ways to retrain people who find their jobs being displaced so that everyone can continue to move forward and thrive in today's economy.
If you had unemployment at 4.2%, Raphael, that would normally constitute pretty much full employment or thereabouts. But members of the FOMC, I know that you're going to be a voting member next year, still think there's a lot of slack in the labour market. Why?
So I think there's diversity of views on the FOMC, and I'm sure you've seen and reported on many of those different views. What I would say is we know for sure that there is tightness and a lack of slack when you see prices move in response to the increased production of jobs. Right? If we haven't seen that, then some people are going to take that as an inference that we're not there yet. I personally think that...
Is it participation rate? Is that what you look at here? Because that can also be misleading.
Well, data can go a lot of ways, and you can interpret a lot of ways. It's one of the reasons why we also try to get into the field and get beyond the data and the aggregate numbers. What I would say is this, there is a lot of diversity about what exactly the number should be in terms of full employment. What I would say, in my viewpoint, is that whatever you think the number is, we are moving close to it, and we're moving there rapidly. And to the extent that we get there, that should translate into upward pressure on wages.
Raphael, do you think the danger of a too dovish Fed and how that plays into asset prices is a problem? Are you concerned about a potential asset bubble building?
So, yes, we always are concerned about whether our policies are having adverse effects on segments of the marketplace. I've had most of my focus on the real part of the economy to make sure that we are creating policies that allow firms who are producing things and hiring people and consumers who want to make decisions about long-term investment, that they are best positioned to do that. As developments happen in financial markets, we definitely look at that. And I've had my staff try to give me some insight as to what are the sources of the growth and the frothiness in financial markets, and are they things that we might be contributing to and might need to take more consideration of in the months to come.
Now, of course, one of the big questions hanging over the Federal Reserve are the personnel changes, starting with Janet Yellen, the Fed chair. Her term's up in February. Stan Fisher, the vice chair, he's already gone. And I think sometimes when you're new to an organization, you see it with fresh eyes and maybe ask the best questions. When you look at filling this position, what do you think the administration should be looking for? What's your sense of this?
Well, I don't get to make that decision, so I'm not in the place to give the president any advice on this. If he wants it, he can certainly call me and ask for it. What I would say is this: it's been a pleasure to work with both Vice Chair Fisher and with Chair Yellen. Both of them, they're smart, they're personable, they're inclusive, so they've really made me feel very welcome as a new member of the Federal Reserve leadership, and they listen very, very carefully to what everyone has said. I've really enjoyed working with them. But that said, I've worked with a whole lot of people with many different backgrounds, and whoever the president selects to be the chair and to fill the vacancies on the board, I'm looking forward to working with them, and we'll find ways to really work together to make sure our policies are maximally effective.
Speaking of colleagues, Neil Kashkari, your colleague from President of the Minneapolis Fed has said the Fed should not be raising rates until inflation is actually showing evidence of really hitting 2%. Jim Bullard, who has been quite a thought leader on the Fed, president of the St. Louis Fed, in an interview today said he's concerned about the Fed losing credibility if it starts moving with inflation so far away from that 2% target. Seems to me, though, that you're in the other camp right now. You don't agree with Jim or Neil.
So I put myself more in the middle. I'm open to letting the data tell me that the markets are not moving and responding in the ways that I'm really expecting them to. I will say my expectation is that these tight markets will eventually translate into upward pressure on prices, and I think that's likely to happen sooner rather than later. But as you know, you guys have been watching the Fed for a long time. I've just been here for a couple of months. We've been talking about this as an institution for quite some time, that the wage growth is imminent, that upward pressure is imminent on prices. So I'm starting with new eyes. It looks imminent to me. But if the data tells me that it's not here, I'm happy to make sure that my recommendation for policy reflects that reality.
Raphael, what about quantitative tightening? We had easing, of course, going into the program, so this must be tightening. How do you perceive it? It has inherent dangers, just as quantitative easing did when that started.
Well, it does on its face. What I would say, and one of the reasons I'm here is because we're co-sponsoring a conference with the Hong Kong Monetary Authority on issues of an unconventional housing policy. It's unconventional monetary policy. It's been quite interesting. And one of the things that we've been reflecting on is our plan for the exit is not nearly as dramatic as our plan was for the entry. And so, as we've announced, we're going to pull back on our repurchases at a very slow rate to begin with, maximum $10 billion per month on a $4.5 trillion portfolio or balance sheet.
Take an eon to get rid of that.
It will take a long time, but in part that's because what we want to do is make sure that as that policy starts moving through, we understand how the market is digesting it, how it's responding to it, because we don't want that incremental tightening to shift the economy into a place that will require more dramatic policies or perhaps even be counterproductive.
Raphael, you're here with the Hong Kong Monetary Authority, which tells me one other thing, that we have a dollar peg, so what happens with monetary policy in the US affects us directly, but perhaps it's also an acknowledgement that the Fed is more outgoing now than it used to be, or outward-looking, I should say, because what you guys do ultimately affects the world.
So what I would say is this. I think that the staff of the Fed has long understood that we interact with the rest of the world. We're not on an island. We have an international finance division at the board in Washington. I have people on my staff who routinely are overseas and engaging with policymakers overseas. And, we co-sponsor a bunch of things. We co-sponsor the conferences with people here in Hong Kong. We go to Canada. We go to Europe. So I think that the perception about us as being very inward-looking actually is a little off the point.
I said you were less inwardly looking. I said you're more outwardly looking.
If you want to go relative, I'll go with that. I'm still new, so I can't. I'll have to check my predecessor Dennis Lockhart's logs to see how much he went. But we definitely are going to engage in the international space and make sure that our policies are not detrimental to a broader world economy.
What do you look at, what do you see when you're looking at China and what the PBOC is doing? We see sort of always these indications that the PBOC perhaps are picking up certain tools and adapting them to China, but how do you rate what they're doing in terms of monetary policy?
So I don't have a strong opinion on what they're doing. Just starting, my first job was just to really understand the U.S. economy and some of our closest partners. I will start to look at that more carefully in the months to come. What I will say, though, is I do think that, from what I've seen, the monetary authorities across the world, the central banks, are talking to each other a lot, and we're trying to make sure that our policies do not go at cross purposes to diminish the impact of any of them. And so my expectation, I have staff who just came from China. They're having these conversations, and I'm looking forward to learning more about their thoughts on it so I can have a better opinion on that.
Yeah, we saw the impact across Asia, right, during the taper tantrum and some, war of words from the likes of the Reserve Bank of India, the chief there at the time, Rajan, saying that the Fed can't do this without better communicating. But I wanted to talk about, the unwinding, because so far, we've been getting... Go on.
Oh, no, I was just going to say, one of my messages at this conference was that we as an institution and all central banks indeed need to be much more clear in our communications, take extra steps to articulate what we're doing, why we're doing it, what our end goals are. And so I think it's fully consistent with what you're talking about in the context of the taper tantrum. I actually think it's one of the reasons why when we announced this new policy to the quantitative tightening, if you will, that the markets did not respond in a dramatic way. I think that's a sign of the successful implementation of a communication policy to really make sure the markets understand what we're doing.
Raphael, what about banking regulation? That's another role you're taking on as being a member of the Fed. The Treasury Department put out a big report last week about rolling back, revisiting regulation. In Atlanta, in your experience in public policy and more, where are you on board? Should regulations be rolled back? What's needed now?
So I would say two things. First, I don't actually have a decision-making role in this. That's something that the board does, and I'm looking forward to working with Randy Quarles, who will be the new vice chair in charge of supervision, to give him intelligence about what I'm seeing in my district. That said, the regulatory environment is always one that is evolving and changing as the banking sector and as the economy evolves. And I've often described regulation and in fact just about all of these things as a pendulum swinging. And so to the extent that that swing has gone a little too far in terms of constraining activity, I think that's something you always have to look at. The details of what the relaxation will look like, I think, does matter, and I'll be informing our folks my thoughts on that as those become more crystallized.
Raphael, very quickly, we seem to have a Fed speaker every day. I'm not saying anything bad, but there seems to be a lot of noise.
Right?
There's so much noise coming out of the Federal Reserve right now. How do you separate the wheat from the chaff? And it leaves me more confused than ever.
Well, I'm hopeful that that's not actually the case, and that what you're...
It wasn't like this under Greenspan or even Bernanke.
It was not, but I think that the Fed's in a different position right now. I mean, the nature of our policies has put us much more in the day-to-day policy space, and I think that requires a different level of engagement from the institution. And, I will tell you that in my district, people are not saying that they're hearing too much of the Fed. They want to hear more. So I'm going to go. But I do want to say this. I think that there's usefulness in really talking clearly about why we're making the decisions that we do.